half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Our top stories today. Chinese shares on the brink of a 5-year low with bearish sentiment gripping the equity market. Stocks elsewhere in the region, though, tracking Wall Street's recovery slightly higher as dip buyers start to emerge. Now, Chinese biotech firms in focus are in the crosshairs after the House passes a bill blacklisting them and also their U.S. units. Also ahead here on shows, Huawei's new phone set to debut later today, just hours after Apple unveiled its latest iPhone with AI tech that isn't quite ready just yet. And of course, HSBC also in focus. Shares get traded this hour, said to consider merging its commercial and investment bank units to cut costs under its new CEO.
All right, take a look at the market action. It is a bit quiet out there, but there you go. You are seeing a little bit signs of maybe that rebound that's gained some traction here after what we saw on Wall Street. So there was a bit of bargain hunting, as Dave mentioned there. We're seeing a little bit of that in Asia here this morning with Taiwan just coming online, watching TSMC shares very closely, just given what we saw in the ADRs, which definitely popped in the U.S. session. But 0.6% to the upside on the TAIEX as well. The Nikkei is also recovering. Well, yesterday basically recovered during the later part of the session. Yeah. And really started to see, we were seeing declines as much as 3% at the early get-go. We basically still ended things slightly flat as well. Dollar yen is also back at 143 levels here this morning. Not much movement in the Treasuries market, although we have seen some traders trim their bets of that 50 basis point cut at the next Fed meeting in September. I mean, last week it was as high as 50%. Now we're talking about maybe closer to 20%, and things have settled from there. You take a look at what Brent markets and the like. Morgan Stanley cutting their forecast once again when it comes to Brent to $75 here, just on what they've been seeing in terms of the overall demand picture and the like. Iron ore, though, is still seeing a slight rebound this morning. Golden Dragon did this overnight. Not a whole lot of movement either, but slightly in the green. So we're watching very closely. Dave mentioned about this Biosecure Act. Certainly the healthcare sector, the likes of Wuxi and those peers are in focus in the Hong Kong session today. We've already heard some response from these companies about how they don't pose that national security risk. We'll see how the stocks react to that. Futures looking like this right now, and the approach to the open, obviously we're focusing on, yes, we talked about CSI 300. We're getting back to those levels that we saw in February, and if that's the case, that is going to be that 5-year low for that benchmark there, Dave.
Yeah, 31.79 is the level you want to track as we approach the open today, and of course trade nerves coming through. We're coming off the soft inflation print out of China. We're moving into this U.S. inflation print as well as we, if not already, enter this blackout period as far as the Fed is concerned. Mark Cranfield is with us right now out of Singapore, MLife strategist, to talk us through, of course, this. And Mark, I mean, the headline is dip buyers have emerged. We could apply that really more so to the U.S. I'm looking at price action in the Asia-Pacific right now. We aren't as convinced as our peers in America. What do you make of that?
Yeah, I can see why people are a bit hesitant, particularly because of China, some of the factors you just mentioned there. And obviously Japan is in a somewhat different situation as well. People are still bruised from the big sell-off in August, and Japanese equities are still looking as though they're churning through, trying to get rid of some of those positions from that time. You can see on the surface, you can see why dip buyers, particularly in Europe and the United States, would be more encouraged. I mean, last week was the worst week for US equities in something like 18 months. And if you look back at what happened afterwards, back in the first quarter of 2023, after that big sell-off, there was then a few weeks of decent rally for US markets. But of course, they're coming from a much different level. At that time, S&P 500 was much lower than it is today. The outlook for the US economy was much stronger. You weren't in a situation where you're approaching US presidential elections. The Federal Reserve, although they weren't on the verge of lowering interest rates, people have to consider the reasons why they might be doing so, and possibly the Fed is behind the curve already. So the situation is a lot different. So we'll need a lot more than just wishful thinking for dip buying to really get serious this time around. So it may well be that the little bit of action we've seen this week, where markets probably got oversold going into the weekend, that's not surprising. But to sustain the dip buying over the next couple of weeks, when you have a Fed decision coming up in the very near future, is probably going to be a lot more difficult because the outlook is so much more unpredictable than it was. And if you think of the AI story as well, which helped to propel equities last year, that's a much older story. It's been around. There's some people suggesting it may be rather long in the tooth and he's overinvested already. So certainly comparing this year with 18 months ago, it is not as rosy an outlook as it was back then.
Mark, obviously we're just very close to this presidential debate that's happening in the U.S. tomorrow morning, our time in Asia. What can we expect? Obviously, we're starting to see, maybe Kamala Harris is losing a little bit of momentum leading up to this. In terms of the market, what assets should we actually care about leading up to this debate?
Probably the two places where we'll see price action. If there's any kind of clarity coming out of the debate, S&P 500 futures definitely will be the place to watch. Traders will be all over that one for short-term movements, and probably dollar yen as well, or the dollar in general. So what traders will be keeping an eye on the betting odds. What they'll be looking for is something like we had in the debate between Trump and Joe Biden earlier in the year, as it became reasonably clear that people thought Trump was winning that debate. The betting odds skewed very much in favor of Donald Trump, and then markets started to react with some of these so-called Trump trades, bit of curve steepening, a little bit of dollar strength. Those things started to happen once it looked as though people were putting their money on Donald Trump. If we get anything like that come out of the debate this week, where one candidate is seen to be doing much better than the other, then you will start to see some market reactions, and probably US equity futures is the very first place that you will see that happen. But this time around, the bar is much, much higher. I don't think anybody is expecting Kamala Harris to put in a performance that measures something like Joe Biden did last time. So it's probably going to be a lot closer, a lot more nuanced, more difficult for people to read. But keep your eye on the equity futures and the US dollar. They are the two likely places that will respond the first.
Absolutely. Mark, thank you so much. Mark Cranfield in Singapore for us. And just a housekeeping note, of course, this time tomorrow will be our special, of course, that goes into that debate that takes place, well, literally this time tomorrow. In the meantime, though, a full trading day left, and hopefully we'll see that rebound play through in these greater Chinese markets, likely in Hong Kong more so than mainland China, which if you judge it by past or recent correlation, that might just be the case. We have, of course, HSBC shares in focus, big pop in shares in London overnight. You have an NPC standing committee meeting. This event, of course, out of Huawei around mid-afternoon, around 2 p.m. local time. Watch for that very, very closely. But before that, though, we have, of course, some trade numbers set to come through at some point between the next 90 minutes or so, the next 3 hours out of the Customs Bureau, and we'll see what that shows as far as exports and imports go.
Yeah, let's bring in Frederic Neumann, Chief Asia Economist and Co-Head of Global Research Asia at HSBC. The narrative seemed to be this year that exports was really kind of keeping this Chinese economy going. Is that going to likely be the case for next year?
Well, one thing is what happens with the U.S., right? Because it's the U.S. that's really driving the demand for global goods. If you look at Europe, it's not much happening in terms of demand. If you look at other economies, it's kind of ticking sideways. It's the U.S. that's keeping up the global trade cycle. Now, if there's a recession in the U.S., then there's going to be very little outlet for Chinese exports. Plus, we have a potential tariff risk coming in here as well.
So, based on the information you have now, what's the general sense of which way you think exports are going to trend over the next 6 months?
So for the next few months, it looks like we're still going to have fairly decent run of shipments. If you look at pre-orders of vessels, for example, right, that looks fairly solid into year end. There is a sense, though, that there might be some front loading of shipments as well, in anticipation that we might get actually some tariffs coming in at some point next year, of course, depending on whether, depending on which candidate wins. And that could flatter the numbers now, and then it gives a payback probably by first quarter next year. You might see trade rolling over, and that, of course, is something Chinese policymakers need to take into account, because on the domestic side, things are not going well. Yeah. Well, if exports start to fizzle as well, then you really got to hit the gas on stimulus.
We saw that domestic picture look still weak in the inflation numbers yesterday. I'm just wondering, is this sort of second phase of deflation looking more dangerous to you now, Fred?
It does a little bit, because the first phase, the property market kind of deflated, and of course there were high base effects because we had high commodity prices, the whole world had inflation, right? But now we see kind of that very weak inflation persist, and we know that consumer confidence is still under pressure. We know that we haven't seen that turn in housing sales, for example. So the big risk now is whether these inflation expectations becoming entrenched. That is, that consumers believe, actually, you know what, I don't need to buy anything now. I can wait 3 months, it'll be cheaper. And that's obviously a big challenge for monetary policy.
Yeah, and what the interesting part, at least in the last week or so, was, the comments coming throughout of the former PBOC governor before the inflation numbers came out. Should I read anything into that? Is that an indication of policy intent, for example?
Yeah, maybe he had an inkling of what the numbers will be, but certainly it's a broader narrative that matters here. And it's certainly noteworthy that we have an official come out, a former official, saying, look, guys, maybe we need a tweak here. And I think he's well respected in the market, so certainly people are paying attention to his comments. I don't think officials are kind of laying back and not ignoring this issue entirely, but it does give you a sense of urgency behind these comments, and so maybe there's an argument for speeding up here some of the policy measures that they're already planning to roll out, just because to buy yourself a bit of insurance that things are not going to kind of deflate much further.
Is that why you're keeping that 4.9% growth forecast for China this year? I mean, you're anticipating that something could follow.
That's right. So 4.9%, really, to hit that, we probably need still some tweaks coming through. Now, we have 20 basis points in interest rate cuts there. We still have accelerated bond issuance, for example. There's a lot they can do to kind of lift things a little bit into year end. Yeah. But remember, that is massaging the cycle. It's not necessarily addressing the structural issues. So next year is another debate entirely.
Can we still be confident, as we were 12 months ago, as we were 12 months before that they had the policy toolkit to deal with this, that we are not headed into some Japan-like conditions in this economy?
They got the policy tools. The question is, are you going to use them? How decisive are you going to use them? I would actually argue Japan had the policy tools as well and was actually shy in using that. And that is perhaps one of the takeaways from the Japanese experience. And because you wait too long, then, of course, at some point, these policy tools become less effective. But at this point in time, China has policy tools at its disposal to actually rev things up again.
If the Fed starts cutting as early as this month, how much does that help China, do you think?
Oh, a lot. It helps them a lot. It buys them a bit of space, breathing room, right, to bring rates lower, to kind of stimulate things, to pump on liquidity, without having to worry too much about the currency, for example, trying to hold the line there. So, but it's not just China. Everybody else is breathing more easily, central bankers, I mean, if the Fed cuts rates. So that's certainly an opening for most central banks in this region, including the PBOC.
How does that change how the BOJ thinks about their own policy?
They will have to wait. Those are the only ones, I think, who will not going to. They want to raise rates, but they probably have to defer those interest rate hikes, because otherwise the currency strengthens too much. And remember, the key thing here is the Japanese reflation project critically hinges on a weaker yen. And if the Fed surprises with rate cuts, 50 basis points, and maybe another 50 basis points, and the yen starts flying again, then the BOJ has a problem, because they do not want or can use a stronger currency. They want a stable to weaker currency, and so they will have to defer rate hikes.
But isn't that a problem if the main driver of inflation is simply a weak currency?
It is not the perfect world, but remember, inflation works sometimes through the inflation expectations channel, right? Okay. And now we have raised inflation expectations, and now if we suddenly reverse that, that is, you have suddenly declining import prices, everything falls, great for the consumer in the short term, but he might then think, prices aren't going up anymore, and that introduces then an expectations problem. So you don't necessarily want a much weaker currency. You just don't want it to suddenly have a jerk stronger. And remember, the carry trade, there's still a lot of stuff that could be unwound. We could be talking, I'm just talking risk here, yen at 130, 125, right? It's not out of realm of possibility, but those would do a lot of damage to the Japanese reflation process, a project that we're currently seeing being implemented.
Do you think that's sort of the lesson that was learned from what we've seen with this unwind the yen carry trade? That policymakers just didn't really know how disruptive this carry trade and the unwinding of it really is, and how really influential that yen really is to global markets right now.
Yeah, I think there was a bit of a surprise how quickly it unwound, but it's not all in Japan, BOJ's remit, right? It's really what shifted most was expectations around the Fed. We were here 3 months ago. Nobody were talking 50 basis points with September cuts potentially, right? So that really surprised markets. So it's really the shift around the Fed that presented the BOJ suddenly with a changed external environment.
Do you think the bar for 50 to cut by 50 is quite high?
Still quite high. I think we've talked ourselves into this idea that the floor is breaking away in the U.S. economy. Yes, weaker labor numbers, but I would actually argue that, we've seen such strong labor numbers, an unusual recovery that was very job intensive. That's now needs to come out a little bit. And if you look at the unemployment rate down to 4.2 because the participation rate has risen, income growth is still fairly robust. We had retail sales, which are not bad. I think, this obituary about the current cycle is being written in the U.S. and the recession is imminent. I think we need to be a bit careful about that.
Fred, fantastic. On that optimistic note, we'll leave it there. Fred Neumann, their chief Asia economist and co-head of global research Asia at HSBC. And of course, for our Bloomberg clients, you can read about, of course, that step back piece we did on this deflationary spiral that China may be entering right now. And a lot of the current thinking for many on the street right now, why that might be the case and what's the way out of that. That's on a terminal and also on Bloomberg.com.
Yeah, that downside to that GDP deflator, is it just a matter of months, quarters, or could we talk about the next 12 months? That certainly is what some economists are projecting here. Our very own Bloomberg Economics still thinks a 5-quarter drop into 2025 for that number. Coming up, Apple's bid entice consumers with its new iPhone, offering some modest hardware upgrades and also AI technology that is still TBC. We got details coming up. We're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show. Happy Tuesday.
Right, we're looking at Apple suppliers pushing through the news out of the tech cycle right now. So you have Apple later on today, of course. We also have this Huawei event, which we'll get to in a moment. Of course, the big piece of news, of course, iPhone 16, is it all the rage? Belle is here with us to take us through what we know so far about this, the latest iteration of the iPhone.
Well, we actually had a lot of the details leading up to the event, so it was kind of like pretty ho-hum action, really, for Apple overnight. But the look and feel of the devices are largely the same what we had in the iPhone 15. So all the details we were talking about yesterday, like there's a new action button, for instance, that replaces the mute switch that's now become standardized across all of the iPhones. It was just for the higher-end models before. The higher-end models as well, they're getting bigger screen sizes. There's new colors, of course, coming out. They're sort of the major changes, but again, they're pretty much incremental. The major theme, of course, of the event was artificial intelligence. Yep. Yeah. But this is sort of, I wouldn't say it's undershooting expectations because we knew it was going to happen, but all these AI features are going to be sort of gradually introduced to the iPhones through software updates. That starts from October as well.
Okay. What's the street saying about this launch?
It's sort of mixed as well. Yeah. I think it sort of depends on the rating that you have on the stock. So Citi, for instance, has a buy rating, and they're pretty optimistic on it, and they're saying that this is going to be the most successful iPhone launch that we see in the company's history. So quite bullish, of course, and they're really saying that the case, and that's similar to what Wedbush is saying as well, it's just a careful rollout, and ultimately over the coming 6 to 9 months, you're going to see a lot more demand coming through for Apple iPhones. Barclays is one that's got an underweight rating, and they're saying that there's just not enough clarity on artificial intelligence so far, and so it's really unclear to know how much it's going to drive sales over the coming quarter or two. Bloomberg Intelligence, of course, no rating on this, but they do say that the iPhone 16 design changes are not enough to warrant a refresh cycle. But again, that's sort of the expectation we already had around this, given, as I said, we already had so many details reported ahead of the event.
What about for Huawei, this event that's coming up later today? How excited should I be over this?
This one is quite interesting. I think we were just talking before about the indication we're getting for sales demand so far. And as I was saying, a lot of different outlets are reporting that it's really robust so far. But I do think it's important to give the full context around this, because right now you can express your interest through Vmall, which is Huawei's e-commerce platform. And right now, if you were to go onto it, it would say that there's 3.3 million pre-orders so far. But again, that's just expressions of interest, sort of, because you don't actually have to put any money on the line or hand over your credit card at this point in time. And the pricing is also unavailable at this stage, so something that's going to be revealed later on. But again, something to watch. And of course, we should note again, we will be watching for any sort of updates on Huawei semiconductor capabilities, whether we get any sort of new chips that are launched later today, something to track closely, but no details on that so far.
Might be more about the chips than the phone
Could
itself.
Be.
Yeah. Okay, Belle, thank you. Annabelle Jewelers there, our Asia Tech reporter. Taking a look when it comes to futures and what we're looking at in pre-market here in Hong Kong, we're pretty much flat across the board here this morning. We're still seeing a little bit of hesitation to really buy on these dips, in particular in Asia today. So there you go. But we're watching very closely Alibaba, healthcare techs coming through. We'll give you an update coming up. This is Bloomberg. Some stocks to watch at the open today. We're focusing really on the biotech sector and looking really on what just happened in the last few hours or so here, where the U.S. House overcame that last-ditch lobbying effort and passed that legislation on Monday that would blacklist these biotech firms and their U.S. subsidiaries. So you're seeing Wuxi AppTech down some 2%. They did come out with a sort of statement this morning that says it does not pose a security risk to the U.S. or any other country. But keep in mind, this is a company that gets close to, if not pretty close to half of its annual revenue from North America. That's Wuxi Biologics, I should say. But yes, watching that very much. Alibaba as well. So we talked about this, I think, weeks ago, but today's the day, finally, that is joining the Stock Connect. So you're seeing a pop in those shares, Dave.
Yeah, school is open, right? And we did get to see, I'm not sure if this is related to the Stock Connect, but maybe separately, we're looking at 4 block trades, in fact, and quite a hefty amount, 7.6 million Alibaba shares crossing at 78.30. As you can see, we're a little bit above that, of course, going into the pre-markets today. Speaking of HSBC, also in focus today, big pop in London overnight, 2%, not quite the embrace with open arms from investors in the Hong Kong markets here, of course. And the big news here is the company said to be mulling combining its commercial and investment bank, and we'll talk more about what this means and what that might look like, of course, on the other side of this break, which includes the opening bell.
Welcome back. You're watching the China Show. We're kind of down the open of markets. It is, for the most part, a bit quiet here today. We're still waiting for those trade numbers out of China, so certainly that might be the next sort of event to watch here, and expecting a second straight month where exports do start to slow down a bit here. So that's one to watch. But really, you're not seeing a whole lot of appetite here. In the Wall Street session, there was a bit of that dip buying. Is it enough to sustain some sort of market rebound is still really the big question there, Dave.
Yeah, the investor base don't seem to be biting this in a wholesale scale today. And
we got the inflation print coming up. You got the U.S. presidential debate coming up.
Right.
Still some key hurdles.
I mean, to your point on the geopolitical risk, right? We did just get that a few hours ago with this House bill targeting some of the biotech firms, which they've come out and basically said, no, we're not a security risk for you guys. What we'll see for any market reaction to that. In fact, we'll get more on the story in a moment for you. But in the meantime, very, very quickly, let's go through the open here today. Interesting finding out of Morgan Stanley, and I think this underscores, if we can keep on this just for a couple of more seconds here. So Morgan Stanley came out and said, when you look at Chinese stocks in August, $3 billion was withdrawn from this group of stocks, which really underscores many, many things. One is there's a separate Goldman Sachs report on the global equity markets that hedge funds have been net sellers of global equities for, I think, 8 weeks now. You certainly look at some of the charts, for example. We have one specific one that looks at the MSCI All Country Index. The Fear Greed Index remains negative. So while you are getting, sessions of dip buying, for example, the overall tide is still in favor of selling over buying, as it pertains to what's more dominant between the two. Right, very, very quickly, have a look at where we are in Hong Kong in the open there. So amidst the decline yesterday, we did manage to salvage and close above the 200-day moving average in both the major benchmarks here in the city. Alibaba is another stock that we're tracking here today. As you can see, we're up now 3.4%. So from today, it is now included. You can now buy this across the Stock Connect if you are an onshore investor looking to take advantage of that coming into Hong Kong. The other stock on your screens, we'll talk about NIO in a moment, is HSBC. Not really seeing much reaction there. More on this in a moment, of course, and some of the plans that might be on the table. And, of course, NIO, you just saw at the bottom of your screens, up another 10% on top of the 10% pop we got yesterday. Goldman Sachs joins us, by the way, to talk us through Chinese autos in about 10 minutes or so. Medical equipment stocks, right. So the FDI reports, or the removing of restrictions out of China yesterday, resulted in the limit up on some of these names. You are still seeing that, by the way, for some. So we are getting a day two of market reaction to the news out of China over the weekend. Now, related to this, as a broader sector group, not Taurus News, is biotech, which is a separate group of stocks here. So you have MGI Tech, Wuxi AppTech, Wuxi Bio, down in the early minutes as a market reaction to the U.S. House passing this bill targeting some of these biotech firms.
Yes, so we already heard a little bit from Wuxi saying that this is something that they're opposed to. Obviously, they're saying that there's no national security risk to that, but still not doing much for the stock. We're still down about down 5% for Wuxi Biologics today. Let's get to that scoop from Bloomberg here. HSBC is said to be considering combining its commercial and investment bank units in a bid to cut costs, and this combined division would become the bank's largest revenue generator. We're talking about contributing about $40 billion a year to HSBC's coffers. Let's bring in our senior analyst at Bloomberg Intelligence, Matt Ingram. He covers the banks for us. Matt, I mean, if true, can you just kind of put into context here how massive this sort of reorganization could look like?
G'day, Yvonne. Yeah, look, it's huge. It's definitely not the fine-tuning that the CEO telegraphed when he took the realm in August. It's a big deal. It's combining mum and pop with global conglomerate in the same relationship space. We think clearly it's going to be a cost-cutting opportunity. The real risk here, though, is that you cut away too much flesh and it really hits revenue. It's such a different strategy banking these two groups. And look, this is something the bank hasn't previously discussed under the new CEO. We think it comes with a lot of risk and frankly, I think deserves some more thinking.
Matt, David here. Talk to us a little bit more about that risk to revenue, because to your point, we immediately go to cost cuts, which is probably where we should go. But talk to us about what's at risk here as far as sales goes.
Hey, David. Yeah, look, as I said earlier, it's a really disparate group of customers. Yes, their needs along the way might be somewhat similar, but you're definitely looking at a different sales strategy. It's a bit like the Merchant of Venice, where you don't know where to cut without hurting the patient, so to speak. And I think that's the real problem here. Do you cut this relationship manager? Do you cut that relationship manager? I think unpicking the spaghetti network of who needs to stay and who needs to go, when you're combining these massive divisions, it could prove to be a bridge too far. We've had 3 new CEOs over the last 2 decades, 3 new restructuring programs, and I would hasten slowly if I were HSBC in this instance. I think these businesses operate better apart. Where the CEO has said he might head is cutting out those middle layers of management. I don't think you need to combine these 2 businesses to do that. I think your relationship managers need to stay separate, and keeping them focused on those disparate client groups is going to preserve the revenue in each camp.
Right, Matt, and if you could just also underscore that point for us. So there, the amount of fat that, proverbially would be cut, it isn't as much for a bank like HSBC as, if you compare it to another bank, of course, where there might be more an overlap between those RMs, for example. Just talk us through the cost-cutting thinking here that the bank should be looking at.
Hey, David, look, it's an excellent question. For a bank that over the last 20 years has cut more than 50,000 staff, you would think they'd be running pretty lean. I think the problem is you started with such an organisation of fiefdoms, both across product and across geography, that there is still fat in that middle management, and that's where the new CEO said he'd focus. So The crossover is going to be in the middle. Your mum and pop is not going to cross over with your global conglomerate. Your crossover of the RMs is perhaps in the middle, and where you draw that line of demarcation is a tricky one to balance. So I think for the large part, you're going to have two client groups that are very far apart. As I said then, the skill in this execution is working out where the crossover is. I think the challenge remains to get rid of some of that middle management, to get rid of some of that duplication that you create by having country head, business head in each of the different markets. That's where I think the low-hanging fruit still lies, and I think that's where they're going to focus.
Matt, fantastic insights. Thank you so much. Matt Ingram there, our Bloomberg Intelligence senior analyst on, well, some of the difficult decisions, really, that HSBC faces, if indeed, of course, we're headed in that direction. Let's talk about this other piece of breaking news about a few hours back, certainly a big deal as far as geopolitics goes. So China hawks in the U.S. House have finally managed to pass this bill seeking to blacklist Chinese biotech companies and their American units. You have backers of the Biosecure Act arguing that it will prevent Beijing from dominating another field that the U.S. actually pioneered. Derek Wallbank, our breaking news managing editor, is with us to talk us through this. Derek, maybe just half a step back for our viewers who might not be too familiar. What is this bill about?
Well, David, I think you did a pretty good job of talking it through. You know, this is one of several pieces of legislation. You're welcome, man. This is one of several pieces of legislation the U.S. House is taking up this week in what basically could be called a China week. There's a lot of focus ahead of the election on China. It's an area where Republicans and Democrats actually tend to agree, and so this winds up being a lot of messaging legislation. Now, the thing with messaging legislation is that it occasionally can become law, right? So you do have this particular bill, I know that's gotten a lot of interest. It does name 5 Chinese companies and provides the option for more down the line that would face some pretty serious and stiff restrictions. The key question, though, is, David, is you've got this through the House, right? That's gone through the House today on a reasonably bipartisan vote. But where does it go from here? Now, if you're just sort of looking at the clock, as I want to do, there's not that much time between now and the end of September. 12 session days, as I count it, that are scheduled where you could take this up. And in the Senate, it's not necessarily assured to have a smooth passageway. There could be some opposition there. And so the question is not, is this going to ride by itself before the election? That's actually quite unlikely. But what might it ride alongside with? There's been some talk, and we write about this in our story, there's been some talk about adding it to the annual defense authorization bill. That is under discussion between House and Senate negotiators about what will end up in that package. But that legislation is scheduled to be taken up sometime maybe in November or December, which means that if you are these Chinese biotech firms, you actually have quite a long period of time potentially to be able to lobby lawmakers to just let this one slip under the waves before the year runs out. So no guarantees that this actually makes it into law, even though the House vote today was quite strong.
Yeah, I think the Bloomberg Intelligence analyst that we've been talking to said it's about a 70% chance this could go through. I'm just wondering, though, what is the opposition saying about this? Because there are still some lawmakers that are trying to sink this bill. Particularly what it says, it seems to be picking and punishing companies at random with no sort of clear due process. Can you walk us through some of those discussions?
Well, that is one of the arguments. I wouldn't say random. I would say that these were picked for quite intentional reasons. But there is a concern about highlighting named companies rather than sort of setting a criteria by which an administrative agency would then apply that criteria and come up with the names themselves. Specifying in text is a little bit of a stronger step, and that is one place that some lawmakers who have some investments from these companies in their districts in some occasions have raised some concerns. But I actually think, honestly, that the biggest the biggest problem with this is time. If you put this up in the Senate and you said we're going to have an up or down vote, and then it goes to Joe Biden for a signature, those are all steps that you would say it's probably favored to go through. But even getting there is a challenge, and there are lots of things that could hypothetically pass the House or the Senate that just don't get a vote at the end of the year because you've got too much stuff and not enough time. So that's why I say this is less an issue that is likely to get put up and then rejected versus if it doesn't go through, not getting put up at all.
Derek, slightly different track here. So this time tomorrow is the maybe the only scheduled that will get debate between the two presidential candidates, Kamala Harris and Donald Trump. If I'm sitting outside the U.S., Derek, why should I care about that?
Oh, don't think he heard you.
Okay, well, didn't ask it loud enough. Derek, we'll try and get you back later on, of course. Yeah, so this time tomorrow, it won't be me and Yvonne. We have a special program, of course, coming through your way. The special coverage of ABC's presidential debate. Join us, of course, tomorrow at those times on your screens. 8 a.m. It begins 8 a.m., of course, if you're watching from Hong Kong, Singapore, and Beijing. Right. Coming up, still ahead on the China show, Goldman Sachs refreshes their inflection point framework for the Chinese EV space. Analyst Tina Hou joins us to talk us through what that actually means. This is Bloomberg.
All right, checking EV stocks here this morning. We are watching one stock in particular, which is NIO, which, look at that, we're up about 9% here right now. In fact, we actually have seen that stock gain for about 4 sessions already. Yesterday was already a 13% pop. So I'll continue to see a little bit more optimism post, of course, the earnings that we saw last week as well.
Yeah. At first, when you said NIO, I thought you mentioned the pop star.
Oh, yes.
Yeah.
Coming to Hong Kong.
He's also coming to town.
Tickets already. Yeah.
There you go.
Always get confused by those two.
Okay, let's get it back. Let's get it back on track. My fault, actually. So Goldman Sachs on the car industry, after this most recent reporting season, updated their framework of where they now see this inflection point within the sector. In other words, are we at a point where cash profits have tipped the scales in terms of incentives and what that might mean for capex and jobs and cost cutting and what have you? Let's bring in Tina Hou, normally based in Shanghai, joining us here on set in Hong Kong, the China autos analyst at Goldman Sachs. It's nice to see you and good morning.
Good morning and thanks for having me.
So the tipping point or inflection point, how do you guys define that loosely?
Right, so basically we have a framework to look at the potential tipping point or inflection point of a cyclical industry by looking at 3 things. Number 1 is the overall industry profitability. Are majority of the players in the industry at or below cash cost level? Number 2 is, are management capitulating? Are they turning negative and pessimistic about the future? Because that's when they will start to cut capacity and cut headcount to really facilitate a potential supply-demand rebalance. And number 3 is we try to gauge the potential tipping point of when the consolidation might start. So what's interesting post the second quarter result, our findings is, number 1, the biggest surprise is actually the overall China OEM space. Actually, overall profitability improved for the first half versus last year, as well as versus on the quarter-over-quarter basis. And the overall EBITDA margin of the top 13 OEMs actually increased by about 130 basis points, despite the very fierce price competition in the market. That's the biggest surprise to us so far this quarter.
So that means that tipping point gets pushed out. By how much now?
Right, so if we also do some stress testing of the loss-making OEMs. Even though they're loss-making, the reason they can still compete is they have net cash on their balance sheet. So we calculate at the current rate of loss, how many months it will take for them to turn from net cash to net debt. And then the conclusion is that it's probably going to come around fourth quarter this year, first quarter next year, and maybe like into second quarter for some of these guys. But that, compared to last quarter, has been pushed out by about 1 quarter's time.
Are we eventually headed in that direction, though? Do we get to the tipping point? And if we do, for those companies that might run out of cash, what happens then? Do they get bought out? Do they raise cash? What are the scenarios for you?
Right. So overall, our conclusion here is that the potential tipping point for the EV industry might not come before around 2 to 3 years. Okay. Because if we look at the top 13 OEMs in China, actually 10 of them actually are still EBITDA positive. And then 12 of them out of the 13 have net cash. So that means they still have room to compete on pricing. And then we cannot rule out further funding sources for these guys. But I think there will be a time that comes, because price competition is inevitable. Yeah. And by that time, if we look at the auto industry, currently there are around 30 EV OEMs in China, over 60 passenger vehicle OEMs in China. So if we look across to the other global markets, the size is half. So I think it's a more healthy level is probably 50% of the capacity or the players need to.
You mentioned that window for price competition. How much more could we see in terms of price cuts before we get to that sort of cash cost that you mentioned?
So I think for different companies, definitely different. Coming out of second quarter, some actually improved. So the top 3, for example, BYD, if we look at their elasticity, they still have 20%. Room to cut price. Okay. And then some of the others like BAIC and Great Wall, they have above 15%. The middle group have around 6 to 7% on average, and then the lower group have around 2 to 3%.
Okay. Is that a function of branding, or is it a function of the cost structure? Like BYD, for example, are they just good at scale and cost, for example? Like how do I differentiate? How do I look at elasticity between these 30 OEMs?
So this is the percentage we calculated is mainly a function of the EBITDA level, unit EBITDA. So basically, we assume they are willing to get to EBITDA 0, and then that's the sort of room they have to cut. But to your question, what makes the an EV player stand out and eventually win? We think it eventually comes down to production efficiency, cost control, and overall just execution efficiency, especially in the current industry where both hardware and software is developing very fast. So you need to really be very efficient and leverage all of the resources you can to push out and launch new models.
So how do you think investors should look at this space right now, whether I'm looking at an OEM or a supplier or a dealership? I mean, what stands out to you as maybe something that you can still be a top pick?
Right. So I think for the overall passenger vehicle market, the August number just came out. It's down 1% year over year, but the NEV space is up 43% year over year. So we've seen the NEV penetration actually crossing over 50% already. But overall, because of the quite scattered industry landscape, I think it's difficult. So it's definitely alpha over beta in terms of stock picking. And what generates alpha, number one, is a new model cycle to grab market share, to grab consumer interest. Number two is you need to be profitable on the cash level for every car you sell, because otherwise you'll be worried about when is my next funding coming from. So number two is profitability. And number three, I think it's definitely the R&D efficiency, the amount of R&D.
Are the incentives different for the state-backed automakers in terms of where do I cut costs? Do I look at headcount, for example? Access to financial resources if I need to, for example. How do I look at that group of companies?
Right, so I think the number two key takeaway we found from second quarter is more SOE managements are capitulating. So some of the largest passenger vehicle makers in China, so obviously SOEs, they are lagging behind, especially the ones that have JVs with foreign brands. Their volume is down about like 15%, 25% year over year. So last quarter, they were still quite confident because they think they have the large scale and then large funding source. But this quarter, we see a 180. They're saying, okay, we don't have a lot of money to spend. We need to prepare to operate on a tight budget going forward. And we foresee a very painful and difficult transition period coming up. So I think in terms of incentives or resources, it's not that different, but then it's more of like the capability for R&D, for product launch, as well as for sales marketing.
Tina, great stuff. Thank you, Tina Hou there, China Autos analyst at Goldman Sachs. We got plenty more ahead. This is Bloomberg.
We somewhat knew it was coming, not for certainty, of course, but now that it's come, and the latest development, of course, is this bill. We're seeing market reactions to some of these these Chinese biotech stocks on the back of that news. We'll unpack this further a bit later on in the show, of course.
Yep. Coming up in the next hour, though, we have StashAway CIO joining us to talk about ongoing concerns over China's economic growth. We'll also discuss the smartphone battle between Apple and Huawei with MSA Capital's Ben Harburg. This is Bloomberg. Welcome back to the China Show. We're here to look at the HSI a half hour into the session, and there's really not much to really tell you about. We're slightly higher here this morning. We talk about all the event risks that's coming through here, right? Whether it's that U.S. presidential debate, whether that's U.S. CPI print, where the market is now turning its focus now back into inflation. So certainly that's going to be one thing we're watching out for. Tech is slightly lower here today in China as well. But Dave, what else are you watching?
Well, since you're talking about tech, one stock that is moving against the grain is Alibaba.
Yeah.
In fact, coming up on your screen. So this is a Stock Connect story in both. So Baba from today is now, can be bought over to Stock Connect. Shermao was down as much as 30% because it has been removed from that program. I'm not sure it's a one-to-one deal, though. Like, one is in because one is out, because almost like an index rejigging. But in any case, of course, that's a story respective to both specific shares there. The broader story, though, to Yvonne's point is, while we're not getting that follow-through in the Hong Kong markets, we are seeing that show up in some other parts of the Asian equity complex, like Japan, like Korea, not to the extent, which is the other point, not to the extent of the rally we had overnight, where we had a 1-2% gains, of course, on Wall Street. But we are getting some green on your screens. So we are moving into, of course, the next big event is the U.S. CPI print, which is mid-week, right after the U.S. presidential debate, of course. We have to get through that as well.
Yep. Let's bring in Stephanie Leung, Chief Investment Officer at digital wealth management platform StashAway. It seems like right now investors are not too keen on buying on these dips here right now. What do you make of last week's sell-off? Was this just a pullback of a longer-term trend, or do you think there's actually a change in regime here now?
Yeah, I guess, there has been a lot of investor debate into whether or not we're entering a U.S. recession, particularly with things like the SARM rule being triggered and unemployment rate kind of increasing. But I think it's important to kind of take a step back and to look at, how equities have performed year to date. Very well, right? The S&P and global equities are up kind of high double digit year to date so far. And that exceeds the average return of 10% over the past 30 years on an annualized basis. So I think we're starting from a level where there's some froth in the market. There's been a lot of good gains this year. And if you think forward the next 2 months, there's going to be a lot of uncertainties that we've talked about before into the U.S. election. Now it's sort of a 50-50 chance of Harris or Trump winning. And if I were kind of putting myself or putting yourself into investor shoe, given how you've kind of made good returns this year so far, you would take some profit and just kind of wait it out.
Okay, well, that's the question to the same, the other side of the coin. Do I buy this dip? If so, where might valuations now look relatively attractive?
Yes. So I think if you take kind of a longer-term view of the key question is, of course, whether the U.S. is heading into a recession, because I think that kind of plays out whether you should buy the dip now or you should kind of seek safety. I think if we look at some of the consumer data, the consumer kind of is still quite strong in the U.S. And if you look at high frequency data like credit card spending, I mean, these are still trending up. And indeed, if you look at the global PMI, the PMI this month, even though manufacturing is actually slowing down, service is actually picking up. So I guess on balance, we don't see any systemic risk kind of rising from the U.S. economy, which signals that you will go into recession. There is some sort of slowdown. Some of this is temporary into the election. A lot of companies are saying we got to wait for a lot more kind of clarity in terms of the policy in order for us to make investment decisions. Some of this is actually slowing down of the kind of unemployment or U.S. labor market, which is quite normal. So I think all in all, I think we don't see imminent risk of U.S. recession, and that's why we think still for long-term investors these days are kind of when there's a dip, it's a good point to buy. And also remember that the Fed is actually starting its rate cut cycle very, very soon. And if you look at historical data, 6 months, 12 months down the road, post the first Fed cut, bonds, equities, gold, I mean, these tends to do quite well.
Yeah, tell us about gold. I mean, you mentioned about the flows that you're seeing into some of these ETFs that you look at. Yes. What does that signal to you?
Yeah, I think maybe to a lot of people's surprise, I mean, gold this year has been the best performing asset class year to date so far. Equities is now up sort of 16%, gold is up 20%, bond is the biggest lagging kind of asset class. I think that tells you a few things. Number one is that the uncertainty about the economy, I mean, that's prompting people to kind of seek safety. Secondly, if you look at the flows of central banks, I mean, these central banks are consistently buying gold in diversifying their U.S. dollar asset base. I think that is due to cyclical as well as structural reasons. From a cyclical point of view, from kind of the Fed cutting cycle, that means like weaker U.S. dollar, and also that plays well into holding gold. And from a structural perspective, I think we talked about this before, right? If you look at the U.S. fiscal condition, they will continue to spend, and the U.S. kind of fiscal debt will continue to build. Central banks globally understand that dynamic as well, and therefore, earlier this year, we've actually made a decision on our platform to include gold as a structural allocation. So I think about like kind of the traditional 60-40 portfolio, 60% equities, 40% bond. I think that's not enough, right? If we think kind of structurally, we should include gold as part of the asset allocation.
Okay, so, but that only adds up to 100. So where do I take that allocation? Well, how do I fund that gold trading? What is the structural allocation to gold?
Good question. And I mean, for us, I mean, we've actually taken some allocation from bonds. Given that if you think about bonds, I mean, a lot of that is actually U.S. Treasuries. And I think, number one, structurally, we may be entering a kind of higher inflation regime, which is not great for bonds. And then secondly, of course, the U.S. fiscal condition is another concern. So, I mean, we're kind of, if you think about bonds, it's sort of like a safety asset. And I think gold is also a safety balancing asset as well. And to kind of mitigate the ups and downs of equities, we use either bonds and gold. And just from our perspective, gold actually serves as a pretty good balancing asset going forward.
Okay. I'm going to ask you about China now. In terms of, is there anything that you see on the horizon that could actually turn around this market?
Yeah, I think if you look at some of the monthly data that we track, indeed, things have not turned around, and you can argue that it has deteriorated somewhat in the past few months. So, for example, importantly, if you look at the Chinese property market, property prices are falling in the tunes of 5-6% annualized per month. And that is a big issue because I mean, if you think about the household wealth of a lot of Chinese people, that's in their homes. And if you see kind of your home prices falling every month, you would be concerned and you would not be spending a lot of your kind of discretionary spending. The other thing that I like to look at is the credit impulse done by Bloomberg. I mean, this is a very, very good indicator of how things are trending. And it tends to have a leading kind of property versus the equity market about 6 months. So credit impulse has actually bottomed in April, but still today it's in negative territory. We need to see that credit impulse getting it back into positive for us to kind of get more positive in China. I think there's a bit of a kind of timing component to this because of the U.S. presidential election, right? If you think about the Chinese officials or leaders, they would need to kind of get clarity as well as to who's going to be in the White House for them to come up with the right set of policies. So I think there's a bit of timing as well.
Okay. Well, that's our question of the day, and I'll put that to you. Which assets do you think will react the most, if at all, to this U.S. debate this time tomorrow?
Yeah, I mean, that's kind of all eyes on how it goes tomorrow. And I think it really comes down to what are the odds of Harris or Trump winning. I think, the debate will be important, but one debate actually is a beginning of maybe some of the kind of tighter racing or kind of tighter interaction between the two candidates. But it's not enough to determine who's actually going to win at the end. I think if we take a step back, we actually did some work as to look at which factors could tell us the best as to, which candidate would win. And we've looked at many different factors, and if we have to choose one factor, the really key factor that has shown historical predictive power is actually the economy of swing states. So when we look at the swing states today, the economy is actually still quite strong, and historically it has a preferred significance for the incumbent. So given that, maybe perhaps the incumbent has a bit more favor going into the election.
And I feel we do this mental exercise every time there's a U.S. election. So if we know likely who might win, do we know who might be better for markets?
Yeah, so far this year, it seems like Trump would be better for markets. And of course, Trump talks about the extension of the tax cuts, perhaps being a bit more market friendly. But we also have to remember that there's also the trade tariffs, the uncertainty. So I think it's still too early to say. But the markets hate uncertainty. So whenever there's certainty as to who's actually winning, I think that the market then gets through it, and it comes back down to economic growth, fundamentals, Fed interest rate path, etc.
So Powell better deliver.
Yes.
It's the short word. Thank you so much, Stephanie Leung, there, Chief Investment Officer at StashAway. Just on that very note, this time tomorrow and still ahead, of course, we'll preview the upcoming U.S. presidential debates as Donald Trump and Kamala Harris prepare to go head-to-head, mano-a-mano, for the first and possibly only time before the upcoming elections. This is Bloomberg. Right, it's about 42 minutes into the cash market session, and we're looking at some fairly hefty declines here for some of these biotech companies. Wuxi AppTech, that's the A-share listing, down 6%. The Hong Kong listings was down 11%. We're now down 10% on that. So we're talking about this Biosecure Bill, which targets some of these firms and their American units. Now heading to the U.S. Senate after passing the House a few hours back. Jill Deesis is with us here on set, our news desk editor, to talk us through this. Give us a quick background on what this bill is about.
Sure, David. So look, ultimately this is about blacklisting any of these Chinese companies that deal specifically with biotech. The big fear among U.S. lawmakers is that they could use, the development of this tech, particularly through some of these U.S. subsidiaries. This is an area that the U.S. has traditionally really led on. The fear here is that China could then use this to develop bioweapons. Maybe they have access to, very private, genomic, biological data about people, potentially Americans. So the idea here that the House is trying to do is then ban these companies, blacklist them from the United States, stop their U.S. subsidiaries from working in the U.S. The U.S. House passed this, I think, with a yes vote of 306. So pretty overwhelming majority there. It'll now head to the Senate. I believe Bloomberg Intelligence is giving this about a 70% chance of actually becoming law. But ultimately what this is showing us is that there's pretty widespread anti-China sentiment on both sides of the aisle in the U.S. right now.
Okay, there's this going on. Then this time tomorrow, we're talking about this presidential debate. We talk about it might be just the one until this U.S. election goes underway. How much is this going to matter and change the dynamics of this presidential race?
Well, look, Yvonne, at this point, I mean, we've had a very, very tumultuous summer period where, just a few months ago, Biden was the Democratic nominee, and now it's Harris. Some of the most recent polling showed that actually quite a few Americans, likely voters, I believe around 30%, actually still think that they need to know more about Kamala Harris before actually making a vote. Donald Trump recently was above her in a national poll by a percentage point. So, I mean, really, really tight race here. I think that's just showing you, though, that, there's not a whole lot of room to really move the needle on either side here. I mean, given all of the tumult this summer, Trump was nearly assassinated, and you still have an incredibly tight race going to this debate. But yes, I mean, this is the only debate on the docket. This is really could be the only time that Kamala Harris in particular has to actually present herself in front of voters in this way. So in that way, it could be, potentially very significant here.
And how much should we expect foreign policy to play out? In other words, why should I care sitting outside the U.S.?
Well, David, I think that at this point, these types of debates are actually usually a pretty good opportunity for candidates to talk about foreign policy. We've seen this in past, presidential debates as well, because, look, at this point, Kamala Harris is now starting to roll out her big policy platform. A lot of things have revolved, though, around domestic issues, right? So she recently, rolled out a policy. She says she wants to end the sub-minimum wage. She's talked about minimum wages quite a bit, domestic taxes, that kind of thing. But debate stages actually do traditionally allow for more, talk about the foreign policy space. Kamala Harris, it seems so far, has represented really the Biden administration's stance on China. So, a stronger stance on China, pursuing tariffs, not that dissimilar from Trump, although he's obviously, said that he wants to introduce incredibly, really, really hefty tariffs on China. So, we may expect a bit of China rhetoric to be unfolding in this debate. We'll have to see tomorrow.
Jill, thank you, Jill Deesis there, our news desk editor, joining us this morning. And Bloomberg Television and Radio is going to have special coverage of ABC's presidential debate. You can join us tomorrow from 8 p.m. Eastern U.S. time, 8 a.m. if you're joining out of Hong Kong. This is Bloomberg.
Okay. Well, you guys are just in time as we come back from the break. So ahead of some trade numbers coming through, this one just crossing the Bloomberg terminal, CSI 300, and a level we've been tracking very closely, we've been approaching it ever so slowly, is 31.79 and change. We're trading now just a little bit, 4 points above that level. Now, why is that level significant? As you can see, rightmost side of your screens, we're very close to taking that low out. That's a low that we hit back in early Feb this year. Now, below that, we're back to level to 5 years ago. So we'll see whether or not we do get some support coming through in this market. But as things stand, I mean, we're now down about, so you see the chart from the top to where we are right now, that's about a 45% drawdown. So we could still stay at these levels, or we could be by the end of the session hitting a fresh 5-year low as far as the Chinese equities go. There we go. Bottom of your screens is your headline for now. Okay, in the meantime, we're also getting some, we have some trade numbers coming through at some point this morning, too.
Yeah, so we're expecting that. It's not going to look too good, I guess you could say, but we're starting to see that maybe the export side of things out of China is starting to slow down. In fact, we're expecting a second straight month where things are going to moderate a little bit. Obviously, we've been talking about the barometer of what external demand is going to look like. Fred Neumann from HSBC did mention that. You're not seeing that much demand out of Europe. It's really based on what the U.S. and whether it gets into a recession or not, that's going to really determine the picture for China there.
And the consensus seems to be that the market's gotten ahead of itself in thinking that we are headed for a doomsday scenario in the U.S. That the ground is starting to part, and it's a straight road to perdition from here. But again, we were talking to Fred earlier on. He says to mirror, I guess, the pushback in markets, is that the U.S. is doesn't seem as bad as the market suggests, or as the market wants the Fed to act on. In fact, let's listen to what Fred Neumann had to say and how he phrased that.
There is a sense, though, that there might be some front loading of shipments as well, in anticipation that we might get actually some tariffs coming in at some point next year, of course, depending on whether, depending on which candidate wins. And that could flatter the numbers now, and then it gives a payback probably by first quarter next year. You might see trade rolling over, and that, of course, is something Chinese policymakers need to take into account, because on the domestic side, things are not going well.
Yeah.
Well, if exports start to fizzle as well, then you really got to hit the gas on stimulus.
Okay, just a sense of estimates. Right now, I think 6.6% growth on exports. These are the dollar figures, by the way. So in case the numbers drop, just for comparison, 2.5% on imports, and we're probably going to get about an $81 billion based on these forecast trade surplus. Sorry, you're about to say something.
Oh, I was going to say that's why I think what Fred mentioned is that they're maintaining their growth forecast of 4.9% for China this year is because the fact that you might see that front loading in exports before these sanctions kick in. So that there's enough of that massaging, as he called it.
Massaging the cycle.
Massaging the cycle to try to at least get to that 4.9, around 5% growth target. Next year, he says, when you got base effects, when you got U.S. election risks, and maybe a different story now. But that's certainly the economy is a big topic on today's China Brief. A look at what's making headlines in national newspapers and trending online. You take a look at what state media is saying. So they are putting China's latest inflation print in a more positive light amid growing deflation fears out there. So they're citing experts. The Security Times says that CPI is expected to continue its recovery to 1% in the fourth quarter and around 1.5% next year. So it says an upward trend in prices can be sustained. That's thanks to policies to boost people's incomes and to stimulate consumption.
Yeah. Meanwhile, you have the Communist Party's official mouthpiece, that's the People's Daily, talking about foreign policy, now taking the center stage here when you look at really what's dominating the real estate there, with visits by the Spanish or Norwegian prime ministers. The President Xi's separate meetings with the two officials feature prominently on the front page, with Beijing seeking to boost trade ties with both. And, of course, that comes amidst the broader picture of tensions with the West worsening. Now, President Xi reportedly stressed that the foundation of China-EU ties remains strong. Now, from papers to social media, and of course this is a story we've been tracking as well all morning, the release of the new iPhone and later on what we'll get out of Huawei. So the two, of course, topping discussions on Weibo today with users reacting to the iPhone 16's introduction and looking ahead to the launch out of Huawei later. Some reactions we're seeing online. Apple, I think Yvonne is considering or squeezing toothpaste again, one user says, using the Chinese expression for progress that's too slow, incremental, really disappointed, and waiting for Huawei's launch this afternoon.
Oh, yeah, the trifold. I'm still trying to wrap my head around.
How's it work?
I mean, yeah, it's going to be like an accordion, but then bigger screens, right, which is what people want. Someone said, almost fell asleep towards the end of this Apple launch. Hardware innovation is becoming harder and harder. Maybe we should just wait for Huawei's trifold. Another user saying, if Huawei weren't sanctioned, it would have defeated Apple so many times already. And there's a lot of speculation out there, Dave. If we see some more details on what's in that chip of that foldable phone, is that going to prompt more sanctions from the U.S. to try to kind of take down what the dominance that Huawei has had in China of late? Someone says there's no point in comparing these two, though. Apple fans won't like Huawei's design. The same goes around the other way around. So, yeah, there's just two separate groups, right? It's still at the end of the day.
You have loyalists on both sides.
You still got Android, iOS,
Yeah. Jordan versus LeBron.
Yeah.
Neo, John Legend. Which one do I go see coming up in Hong Kong? Right. Okay, now more on the Apple story, by the way, coming up here in the show. In fact, in a couple of minutes, we'll get analysis from Bloomberg Intelligence on some of the modest, to the point that some of the commentary out of China we're getting, the modest hardware upgrades, and also the AI technology that's still TBC, as well as, of course, the prospects for Huawei's newest device that comes up in just about 7 minutes from now.
Yeah, some other top corporate stories that we're watching for you today. PwC is reportedly set to send in a senior partner from the UK to run its business in China. According to the FT, Hermione Hudson has been tapped to lead its scandal-hit China business. The intervention comes as the fallout from PwC's audit of collapsed property developer Evergrande continues to mount.
Now, HSBC is said to be considering combining its commercial and investment banking units as part of the CEO's push here to eliminate overlapping roles and cut costs. Now, sources say the combined division would boast 90,000 employees. That's about, 40% roughly of the workforce, and become the bank's largest revenue generator, contributing about $40 billion a year. That's about 60% of the top line. Now, El-Hedary has emphasized that he intends to continue his strategy of pivoting the bank towards its core markets in the Asia-Pacific.
All right, market checks here today. We are watching very closely Alibaba, but also there's been some announcements on this new Stock Connect list, right? So the likes of Alibaba is out, Shimao Property Shimao Property is the one that's out. That's where you're seeing shares down some 24%. We're also talking about Zhixing Automotive Technology Kinetic Development Group also doing well here today. EV stocks are also, there you go, NIO up for a fourth straight session. We're up some 9%. This is Bloomberg. All right, we're taking a look at Apple suppliers here. Of course, that long-awaited launch of the Apple iPhone 16. We heard a little bit more in terms of the hardware, not just on the phone, but also when it comes to the AirPods, for example, but also when it came to its AI technology, right? And at this point, people are still thinking it's a kind of build your way up sort of technology, and whether it does actually catch up with the likes of Microsoft and the big giants out there is still up for grabs. You take a look at when it comes to the Apple supplier reaction, it's mixed overall, but you're seeing the likes of LG Innotek in particular that is falling some 7% in Korea today.
Also going to take some time, I guess,
yes,
for this part of the market to feel it. Well, Apple does say its latest flagship device, which is the 16, it was built for AI, but some of the capabilities will be, as Yvonne was pointing out, just gradual improvements with some software updates. Bloomberg Tech co-anchor Ed Ludlow, our colleague, of course, was at that launch in California.
We got 4 variants of the iPhone 16 generation as expected. The iPhone 16, 16 Plus, 16 Pro, and 16 Pro Max. And what all 4 have in common is the camera control button. It's basically a depressed groove on the lower right-hand side of the handset that seeks to sort of emulate the button on a DSLR camera. So real simple, click, the camera comes up, click again, it takes the shot. The idea being that you just don't want to miss the opportunity to take photos of the most important moments in life. But in reality, these were not significant hardware upgrades. On the Pro and Pro Max, there were better quality materials in terms of the titanium, a higher performance processor, the best battery life yet in the iPhone. But this was supposed to be about AI. And when I got hands-on with the Pro and Pro Max, I did demo some of the Apple Intelligence features, but they're limited. But there's latency here. So we know now what the lineup of iPhone looks like for the 16 generation. It will ship September 20th, but we don't get iOS 18.1 until October. That's when Apple Intelligence starts to roll out. And as is reported, a lot of those kind of bigger picture, sort of bright lights features are delayed. Probably the biggest surprise or the bigger news was away from iPhone in the wearables category, where with the Apple Watch, the Series 10 in particular, you have the thinnest watch yet, high quality materials, but sleep apnea detection was actually sort of welcomed and responded to with some fanfare as a significant move forward for Apple in the healthcare space. But all in all, there are still big questions about whether what we got with the iPhone 16 generation will be enough to spur this big upgrade cycle, let alone an upgrade super cycle. Ed Ludlow for Bloomberg News in Cupertino, California.
All right, let's get a little bit more analysis from our Bloomberg Intelligence senior analyst, Masahiro Wakasugi. He joins us now from Tokyo. Masa, tell us a little bit more. Key takeaways for this new phone, and what kind of features really are you focusing on?
Yes, we are seeing that, of course, Apple Intelligence is the major introduction for the AI functionality, and also camera functionality would be the very interesting one. And regarding AI functionality, we can see the automatic sentence changes, probably adopting a new technology, and AI can automatically change the sentences, which should be suitable for the business or maybe SNS, and that kind of AI functionality would be consuming more power going forward. And I think that we are seeing that the battery capacity upgrade every model. So this year we see that 5 to 9% battery capacity improvement, and I think that TDK could be the one of the suppliers for the battery every year for Apple. So I think that that would be the key player if we look at the AI functionality going forward. And this applies to the not only Apple but also some other smartphones going forward. And also, if we look at the camera functionality, it's pretty interesting to see the physical button for the camera. So we think that smartphone makers are pretty much focusing on the camera functionality, and the camera can be the differentiator for the smartphone makers. And Sony is the supplier for the image sensors, and BI scenario suggests that Sony can achieve its record high operating profit for the image sensor for this fiscal year. So that should be the focus for the iPhone 16.
What about, Masahiro, what about foldable phones? And, is Apple part of that conversation? How do you think Apple will deal with foldable phones in the future? And, of course, the Huawei one is, of course, the other one we're tracking, too.
Yes, we expect Huawei to introduce some foldable phones, new models. It may be 3-fold one. And regarding the market size, if we look at the foldable phone market, maybe last year was about just below 20 million units, and this year could be 25 million units. Or if the Huawei phone becomes very popular, the number could be something like 27 or even 30 million units, and it's still a few percent, or 2 to 3% of the total smartphone market. But if we look at the value base, value-wise, the composition of the foldable phones may be becoming more significant. So Apple should be preparing for the foldable phones, maybe expecting 2026 at earliest, or could be 2027. So I think that still some foldable phones may not be satisfying the Apple standards, so it may take some time, but we think that Apple may be required to introduce the foldable phones in a few years going forward.
Masahiro Wakatsugi there, our Bloomberg Intelligence senior analyst, joining us there to talk us through this, his take on where we are on the frontier of this specific technology. In fact, we'll have more on the story coming up on the show here on Bloomberg Television, these new products coming out of Apple, the promises. In the next hour at those times, IDC will be joining us to give us their takeaway and expectations as it pertains as well to the Huawei launch later today.
Yeah, for more on this rivalry between China and the U.S. on tech development, let's bring in Ben Harburg. He's managing partner at venture capital firm MSA Capital. Ben, it's great to have you back on the program. It seemed like late last year, what we were talking about already was the fact that Huawei was already, in some ways, really beating out the competition in China when it came to the iPhone and Apple. Do you see any kind of change in that trajectory now that we're talking about 2 new product launches coming through?
I think that lead will only widen. Q2 2024 was the quarter that Apple fell out of the top 5 in the Chinese smartphone market. And remember, that's not just China. That's the rest of the world where China is dominating hardware. South Asia, Southeast Asia, Middle East, Africa, and Huawei is there alongside of Oppo, Vivo, Xiaomi, and there's no Apple equivalent in those markets. And this 3-fold phone out of Huawei really is specifically designed for meeting these consumer demands, which are different than those of kind of mature markets. So consumers that like to use a tablet for all of their work purposes. So I think that lead is going to widen, and Huawei is designing American components out of their value chain anyway. So it's all bad news.
Ben, let me pick up on that very last point you just brought up. David here, by the way. With this, we've been talking about this competition between the two with you for several times now. Are you starting to see the supply chains align more on respective sides? What progress have we seen on that?
Well, obviously, for decades, the Chinese were dependent on American chips or Taiwanese chips, and of course, ASML's equipment for producing chips, and so a lot of their supply chain was outside of China. With the effectiveness of those early bans, the 301 bans that and entities list bans that hit Huawei and ZTE, China went into overdrive to build their own chips and design out foreign components, and we're now seeing the fruition of those labors. It's not certainly time to declare victory, but this new Huawei Mate XT will have a Kirin 9 chip. They have an Ascend 910C chip, which looks to compete with the NVIDIA H100. And so it's clear that they are moving at light speed and beating any kind of preconceived notions of the timeline it would take them to catch up in designing out foreign components.
Is there anything that you're looking out for in this chip that could be on this Huawei phone? I mean, could it spark a little bit more of that China rhetoric in the U.S. to maybe implement more sanctions on the company? Do you think these sanctions are going to be enough to actually stymie that sort of growth?
I think actually it might cause a reversal and a review of those sanctions to understand that those sanctions have done nothing but improve Chinese and accelerate Chinese self-sufficiency at the expense of American chip producers, for many of whom China was 30 to 40% of their market and of their overall revenue. And that's lost revenue now that was going to go to R&D and aid in maintaining America's chip advantage. And so I think actually it would cause a review. We've already, as America, got our allies in Japan and Taiwan and Korea and the Netherlands aligned to prevent some of the highest end chips from reaching the Chinese. And even in the face of that, the lowest nanometer chips are already being produced locally. Still not at the highest tiers that NVIDIA or TSMC can produce, but very much sufficient for consumer hardware. And so I think this should cause a review and the effectiveness of sanctions in slowing China's growth.
Yeah, well, Ben, on top of geopolitics, and you mentioned slowing Chinese growth, if we could just pivot really to the underlying economics and what's going on with the business environment there, how are you guys doing? How are you and your VC peers doing? How are tech entrepreneurs doing? What's sentiment like right now?
It's a very challenging time. We're calling it kind of the lay flat generation. Valuations of private companies have been flattened down, as they have been across the world, particularly in the venture space. Public markets have obviously been decimated, notably in Hong Kong, but of course even the big names, the Pinduoduos and others that are listed in New York on solid fundamentals and slightly bearish news are being punished 20-30% on Q2 earnings. And so it's a really challenging time in geopolitics. Obviously, overlay it. That's prevented a lot of capital from coming to the Chinese market. But in spite of it, there's still signs of growth. Anything in the core technology space or sectors that are really within the regulatory slipstream of the Chinese government are still getting plenty of RMB funding. And so the robotics space, space tech, operating systems, core technology, quantum chips are seeing robust funding from government sources. And of course, anything built in China for the world, be it EVs, solar panels, cross-border e-commerce, all thriving. So there's plenty of good news, but it's overall set against a very depressed landscape.
Yeah, you certainly kind of painted that, Ben. I'm just wondering, what does it do for a VC fund like yourself? I mean, does it force you to look overseas now and other opportunities?
So we had seen the writing on the wall several years ago. We started and have been investing across the world, and we are a global firm and had been investing in North America, in emerging markets, particularly in the Middle East, dating back to 2015, 2016, and set up other franchises in 2018, 2019 in those markets as well, and set siloed funds. And so I think those that were listening and reading the tea leaves understood that there would be geopolitical challenges and that also China was just going to get a lot harder. A lot of that, low-hanging fruit had been picked. A lot of the new sectors that were emerging required a lot longer time to monetization, a lot more government regulation, and certainly higher technical barriers to entry. And so we certainly expanded with that in mind now, 5-6 years ago, and that has certainly done well for us. But we've maintained investing where we believe there are pockets of opportunity in China, and those have continued to grow. We had a company called Black Sesame go public a few months ago, just a few weeks ago in Hong Kong. It's trending upward. So certainly there are still companies that are doing well, and as long as we stay within that regulatory slipstream.
Yeah, Ben, tell us more about some of whether these are new emerging trends within tech itself that you're starting to notice and might maybe pull the trigger on at some point, or some of the changes that you've noticed. You've lived in China, and how consumers are spending their money, changes in consumer patterns, for example.
Sure. Consumer has changed significantly, obviously because of the downturn in real estate valuations, which hits people's kind of personal net worth, and also, of course, the stock market declines, which had the knock-on effect of creating more job scarcity, lower salaries, even returned bonuses. Chinese consumers are very hesitant to spend. We now have about $12 trillion of household savings that's pent up like a dam, hopefully ready to burst, compared to only about $900 billion in the United States. But what that means is that people aren't spending on big-ticket items. They're certainly not spending on real estate that kind of created that flywheel that was driving a lot of China's economic growth. But they are still consuming, and it's kind of a consumption downgrade cycle. Rather than spending on homes and large ticket, they're spending on events, concerts, going to football matches, which are sold out in China. They're buying domestic brands, so we've invested heavily in domestically built consumer brands, so cosmetics, fashion labels, QSR, so quick service restaurants that are built domestically and scaling very rapidly, that are at low price points. All of those are doing very well.
Yeah.
They're also sticking domestically to travel, so domestic travel.
Ben, thank you so much. Ben Harburg, their managing partner at MSA Capital. Right, plenty more ahead here on The China Show.
Malaysia's deputy central bank governor says a resilient economy and contained price pressures should allow policymakers to keep interest rates unchanged for the rest of the year. Adnan Zalani Mohammed Zahid spoke exclusively with Bloomberg.
The last interest rate move that we undertook was in last year, middle of last year, where we raised interest rates to 3%. Our interest rate has always been traditionally quite low because inflation has been also traditionally quite manageable. So when we have been expecting, I think together with the financial market as a whole, that interest rate policy around the world, in particular for the US, to turn around. So this actually helps in terms of supporting the global growth going forward. But for us in particular, our economy has been quite resilient. And we've seen growth in the first half of this year slightly above 5%. We're expecting for the whole year to be around that 5%. But inflation is still quite manageable. And even we're not expecting inflation to exceed 3%. So in that respect, there's no real compelling reason or any pressure on interest rates to move in either direction at this stage, though we have to be open to the risk, consider the risk going forward. In particular, in terms of a few factors such as how the geopolitics will weigh on markets, as well as whether we do see sustained recovery in international markets.
Well, given what you've said about the outlook for growth and inflation pretty steady, I mean, most economists are forecasting interest rates in Malaysia to be steady all the way through next year, so very steady as she goes. Is that in line with your thinking about possibly interest rates staying where they are all through next year? And again, what might change the thinking around that?
Well, that's way too far to think at this stage. There's still a lot of factors that could come into play. I think for this year, we've seen that scenario where growth is quite steady, as well as inflation, and we're not no compelling forces to push us in either direction apart from that. But I think going forward, it will still depend on what the growth trajectories, and in particular for inflation, turn out to be for the coming year. I think there's still some factors at play for the coming year, which not just on the international environment, but also on the domestic front, where there could be policies that would potentially have an impact on the growth and inflation outlook.
Well, in some of those geopolitical factors that you talked about, obviously China is an incredibly important trading partner for Malaysia, the most possibly important trading partner for Malaysia. And we're seeing, again, even signs this week in data from China of concern about the trajectory for the Chinese economy. How worried are you about that, and how much is that a factor for you?
Yes, China has been a large trading partner for us, and we have been following or tracking the developments in China for the last couple of years already, but they still remain a very important trading partner. Nevertheless, our economy is pretty diversified, and we have many trading partners. Our export composition is also diversified, so this has been enabled us to weather any challenges coming from or lack of demand coming from China. And even if we look at the current growth performance, it's mainly been driven domestic, as well as a recovery in our exports, which has been helped by the tech cycle. But also our non-electronics exports has been picking up, has been quite robust. So while China continues to face its challenges and will have an influence on our economy, but the nature of our economy is actually quite diversified, and we're able to weather through.
And obviously you've talked about those domestic factors and being quite a diversified economy, but I'd be remiss if I didn't ask you about another key thing that's coming up on the global slate, and that's the US election very soon, and obviously big concerns about what that might mean for future US economic, trade, investment policy, and that matters for every country, no matter how diversified their economy is. Are you concerned about what we might see for the US in terms of economic policy, particularly the prospects for an expanded trade war globally?
Well, any trade frictions will always, sort of like be a challenge for small open economies such as us. But we have always been, I suppose, as a country, we've always been neutral and open for business, and I think that's important for us to be able to adapt and be agile in the face of these challenges that could come about. I think so far we have been able to weather that, and we've been able to attract a lot of investments still coming into Malaysia, and I think that will continue going forward. And as long as we're positioning ourselves to be open for business and be business friendly, we should be able to withstand some of these challenges that either way could come from both sides of the aisle of the US.
And that was a Malaysian Deputy Central Bank Governor speaking exclusively with Bloomberg. Okay, we've been tracking the CSI 300. Let's take a look at that, please. There we go. Very, very close. The 3179 is the level that we've been watching. That was the lowest level in 5 years. That was a close back in Feb, and we're just now 2 points right above that level. We'll see how the rest of the day progresses. 30 minutes to go before the lunch break. That's it from us here, though, on the China Show.